All right, so everything I just said, disregard. All right, so we're going to try to use this document camera to, instead of writing on the board, I'll try to use a pen instead. All right, so now, when we left off, we covered the accounting equation. You should understand that the accounting equation, of course, is assets equal liabilities plus capital or equity. Changes in that equation, all the changes have to balance. We started to define assets, we defined liabilities, and now we're up to the definition of stockholders' equity. So let me switch to PC for a second to see if we can get this. So we're looking at the accounting equation, and we said that it should be always equal to assets equal liabilities plus stockholders' equity. We define assets as economic resources owned or controlled by the firm. We looked at liabilities as debts that are owed to outsiders. And now we have stockholders' equity. Stockholders' equity has three components. Its first is contributed capital. The second is retained earnings. And the third is going to be something called accumulated other comprehensive income. We are going to skip this. I have a couple of slides on there, but we can wait on that. That'll come later on in the course. Now, when you think about stockholders' equity, let's go to the next slide. I think I got this working. Okay. So when you look at stockholders' equity, of course, it's called capital. Those are the three components again. We're going to focus on contributed capital. It's also known as paid-in capital, and we're also going to focus on retained earnings. Contributed capital represents the amounts that are paid in by stockholders. Retained earnings, of course, net income or loss that's retained in the company, which I'll explain in a moment. I just want you to see the first part of that slide, which says clearly that the term stockholders' equity would apply to a corporation. We talked about different types of businesses. We looked at sole proprietorships and partnerships. That equity would be called capital. So capital would be used if you were a sole proprietor or a partnership, but for a corporation we use the term stockholders' equity. Now let's define this notion of contributed capital. Contributed capital are amounts that are paid in by shareholders. These are investments in the company by shareholders. Amounts that are received would be equal to the par value of the stock. So let me just try to flip this back and forth here. Let me find this thing. So if you look at a share of stock, par value could be $1. The par value is the face value of the stock. That is the amount that is printed on the stock certificate. If the selling price let's say it's Google stock and Google sells for $40, that means that when they issue the stock, they receive $40, $1 is par, and $39 is paid in capital in excess of par. Now, all of this is contributed capital. So contributed capital is the amount that is paid in by shareholders. It consists of the par value and any excess over par value. This is the amount that investors contribute to the firm. Okay. Now that's the first part of stockholders' equity. Now again, when we think about, let me just move this up, and I'm going to continue this in a minute. Well, when we think about the accounting equation, we know that, of course, assets equal liabilities plus equity. Equity has contributed capital. And for us, we're going to skip comprehensive income. And retained earnings. So the contributed capital, again, is the amount that is paid in by shareholders or invested by shareholders. Now, we're going to skip anything on comprehensive income, and we'll show you in a few minutes how the accounting equation would change. Obviously, you'd expect that if someone invests cash in the business, assets would go up, the cash goes up, and that's how the equation would balance. We're going to do some of that in just a minute. All right. So that would be equity in general, and specifically with contributed capital. Now, typically, what goes under contributed capital for us, we're just going to use the term common stock. As the shares of stock in the company. We're going to use the term common stock. And remember that equity is the owner's claim to the assets. Remember we said that assets are economic resources, liabilities are outsider claims, and owner's claims are considered to be equity. So obviously if you invest money in the business, that becomes your claim. Remember I said about buying the car, if you remember the example about the vehicle, I said that if you bought a vehicle if you bought an auto for $30,000, but you borrowed $25,000, that means that your down payment was $5,000. That $5,000 is your claim. The debt, the auto loan is $25,000. They've got to be paid first. If anything happens, they've got to be paid first. And of course, the asset is the economic resource. So economic resources equals claims against them. Now, on your equity, that $5,000, that down payment could have been contributed. It could have been invested. It could have been the form of common stock, whatever it may have been. All right, now, next, we want to take a look at retained earnings. I'm going to skip anything on comprehensive income. So let's now look at retained earnings. Now, retained earnings will change in three ways. Retained earnings will change by revenue, it'll change by expenses, and it will change by dividends. Retained earnings represents the historical record of earnings that have not been paid out as dividends. So that's in the slides, but let me say it now. Retained earnings represents the historical record. This company's in business for 30 years. Retained earnings represents 30 years worth of earnings, losses, minus any dividends. Now, what's the difference between dividends and expenses? Well, what will happen when you look at this, go back to the doc cam for a second. There you go. When we look at retained earnings now, we're going to see that retained earnings will go up by revenue. It will go down by expenses. And it will go down by dividends. Now, definitely need to explain that. What's another term? If I combine revenues and expenses, gives you profit or loss. So this is your net income or loss for the period. Dividends are not expenses. Dividends are distributions of profit. So make sure you understand this point. I'm going to say it again. I'll put some slides up in a second. Dividends are not expenses. Dividends are distributions of profit. Dividends are transactions with owners. Revenues and expenses are transactions with people outside of the business, correct? So when I sell something, I sell it to an outsider. When I pay someone expenses, I pay it to an outsider. But when I pay dividends, I pay it to an insider, an owner of that company. So these are revenues and expenses. They're outside transactions. The common stock and the dividends are transactions with owners. Now, I'm saying this because in a few minutes, there's going to be a very important differentiation. If I invest $5,000 in the business, my assets go up. If I earn $5,000 in sales, my assets could go up as well. What's the difference? The contribution, the investment, is not income. It's like taking money out of one pocket and putting it into another. Only outside transactions could generate revenue. And we'll see that. So it's an important differentiation, and I make sure that I hit these points as we go along, because these are perennially or historically concepts that elude individuals when they first start looking at this. So dividends are not expenses. Dividends are transactions with your outsiders. All right, so again, let's summarize. Retained earnings, again, is going to be the historical record of earnings, revenues, expenses, losses that have not been paid out as dividends. Retained earnings has the three elements, as I said, just to summarize. It's going to be revenues minus expenses minus dividends. If you have an earlier version of the slides, it might say plus dividends. That was a typo from the publisher. I was able to get in and change that. So it's revenues minus expenses minus dividends. Now the revenues, of course, as I said, going to be transactions that generate assets. Expenses will use up assets as well. And when you have a revenue, the owner's claim increases. So let's say you're a shareholder of Apple. Apple earns income. Your claim against Apple goes up. They owe you a bit more. If there's an expense or if they have losses, your claim goes down. Now, we know that other events, as we said, that are not income, these are transactions with owners. These are transactions involving capital. If you invest in the business, if you pay out dividends, these are owner transactions. Transactions with owners are not income or not expenses. Now, to differentiate that, you have to be very clear what revenues would look like and what expenses look like. So let me say it again. This slide is important in that it tells you that revenues and expenses are going to be differentiated from investments and dividends. Investments are not revenue. These are owner transactions. Owners put money in the business. If you take money out of a bank account and put it into your own business, it's not revenue. Your wealth did not change. You didn't earn anything. You just took money out of one pocket, put it into another. If you take money out of the business and then take it and use it for personal reasons like dividends, you don't have an expense. Didn't cost you anything. You took it out of the business. But if you're paying somebody a salary, if you're paying a sales commission, that would be an expense. That comes out of your pocket. It's never to be retrieved. And if you sell something, sales dollars come in. Those are revenues. So when you look at the definition of revenues, you're going to see that these are economic resources. Again, they increase retained earnings. Economic resources that come in to the company by delivering products and services. You also need to be sure that you differentiate clearly between types of revenues or types of income. Sometimes revenues are derived from normal business activities. Sometimes revenues or income is derived outside of normal business activities. So if we look at the difference in this next slide, this is important in that your revenues are gross increases of assets or reductions of liabilities that would come from your normal business activity. So your normal business activity is selling computers. That would be revenue. Gains would be from peripheral activities, like selling a building or selling a car. You're not in business to sell a car. So take an example of Dell Computer. If Dell Computer sells a computer, it's revenue to them because that's their normal business operation. Right? They're in business to sell computers. That would be considered revenue. If Dell sells a building for a gain, for an amount above cost, that is not considered revenue. It's still income, but it's called a gain. So basically, the way we look at this is that we can differentiate the following. We could say that revenue is from normal business operations, and gains from other business activities. Okay, so revenue is from normal business operations. Gains would come from outside business activities or from peripheral business activities. And both of those will increase income. These are both earnings, will both increase your earnings. So revenues and gains are types of earnings. But we just have to differentiate the source. Now, the same thing is going to be true for losses or expenses. So just make sure you keep that in mind. So again, Apple sells an iPhone, it's considered revenue. Apple sells a fleet of automobiles, it's a gain if they sell it for more than cost. Oops, sorry. Any questions on that? So again, if it's normal operations, it's called revenue. If you have income from peripheral or external or non-business activities, it's a gain. Okay. Now, what about expenses? Expenses are the costs that are used up or the assets that are used up to provide services or products to external customers. When you look at the definition, again, we're going to think about the differences between expenses and losses. Expenses are the cost of assets that are used up. They are asset outflows or increases in liabilities that can or that will result from the normal business activities. Losses are asset outflows or increases in your obligations that result from peripheral or non-business, non-operating types of activities. So again, using Dell Computer, if Dell pays an employee's salary, that's part of normal business operations. If they sell a building for less than they paid for it, they've got a loss. So just like if you bought a car for $10,000, you sell it for $6,000, you got a loss of $4,000. If you sell something for under the cost or the amount you paid, you've got a loss. So again, the expenses are normal operations and losses are outside of normal operations. Yes? Okay, question is, does cost include any additional money you put in to renovate? Yeah. So for example, if you bought, let's use a car, if you bought a car and you decided to redo the interior or put in a new stereo system, that's all part of your cost. And then if you sell the car for an amount less than that total value, it's a loss. Okay. Now, so to summarize that, I guess very similar to what we did here, when we look at, if you want to say these are types of cost, differentiate expenses are from normal business activity or operations, and losses from other or non-operating. These are types of costs. Now again, you have to remember that when we say non-business activities or non-operating activities, it's still part of your business, but it's not something you do every day. So Apple is not in business to sell off cars every day. Dell is not in business to sell off buildings every day. Dell is in business to sell computers on a day-to-day basis. All right. So when you look back at the income statement, I'll put this back up in a second, but when you look back up, I should say, at the stockholders' equity section of the balance sheet, you got revenues and expenses that will generate net income or net loss. We could also add here gains. I'll just put those in parentheses, and losses as well. Okay. So gains and losses could also be included there as well. Okay. Finally, you got your dividends. And as we said, dividends are not expenses. I mean, this is, again, you're gonna start thinking about income. A lot of you are gonna start deducting dividends as expenses. Don't do that, please. I mean, you've got, I think, enough to say here, or enough to see here, I should say, not expenses. Dividends are going to be a distribution of profit or loss. Dividends will distribute profit or loss. In fact, if you go to the next slide, dividends are distribution of cash or other assets to stockholders. It's a return to stockholders. It reduces retained earnings. Dividends, again, are not expenses, but they are distributing income. They don't determine income. The amount that we actually distribute will depend on earnings. And finally, to summarize equity, this is a good slide that will be used to summarize what I just had up on the screen a few minutes ago, but to make it very clean, you have the two parts of capital, the two parts of stockholders' equity. Again, we're not going to play around with the comprehensive income right now. You've got investments by owners that is going to be contributed or paid in capital. It could be at par value or amounts over par. And then, of course, your wealth also goes up. Your capital, your claim also goes up by revenues and expenses, gains and losses. That's your net income. And then it goes down by your distribution. Okay, so your wealth goes up by revenues and gains. It goes down by expenses and losses. And we distribute some of that wealth through the dividend process. And again, just to be very clear, that if you think about the or at least the interaction, revenues and gains, expenses and losses are non-owners. They're outsiders involved with the transaction. The dividends and the contributed capital are owner-based events. So those are transactions with your owners. And basically, if you had your own business, if you transact with yourself, you can't have a income, right? That's the idea. So you really need to try to divorce the idea of the corporation in a sense that if the corporation deals with stockholders, it's really dealing with itself. And therefore, you can't have profit and loss with owner events or owner transactions. So dividends are not expenses, and contributions of capital are not going to be income. Income is only what you see there. Net income results if revenues and gains exceed expenses and losses, and is a loss if revenues and gains are less than expenses and losses. It's as simple as that. We're going to get more formal in just a few minutes, but that's clearly the definitions you need to know. Okay. Any questions before we get involved with a couple of questions for you? And what we're going to do today is, if you don't have your clicker, as I said, try to get it as soon as possible. In response to some of these clicker questions, we'll call on some people to explain their answers. And if you don't have a clicker, you can also explain what you think the right answer is as well. Okay. First question. All right. Now, what we're going to do is review this module, or review this learning objective. So in this learning objective, we wanted to define, first of all, we hit the accounting equation. We understand it has to be in balance. We also hit the definitions of assets, liabilities, and equity, and different types. We describe different types of assets. We describe different types of liabilities. And we just finished describing the elements or the components of stockholders' equity. Okay, so the first one, assets must be owned to be recorded on the balance sheet. And again, I realize you could talk to each other about this and all that stuff, but let's see what you think. Give everybody a minute. This one should be easy. So assets must be owned to be recorded on the balance sheet. What's that? By owned, do you mean like... Owned. Title. Owned means you have to have title. Owned means you have to have title. At least the number of clickers are going up.
It's not working. Last time you tell me when.
Channel 41, right? It's on the wrong channel, that's why. Gotta get it's gotta be 41. Hold on 1 second. There it is. No, where is it? Why can't I get that channel to work?
It was on last time. I don't know.
Yeah, try to get oh, here it is. All right, so that should work now. If it doesn't work, let me know in the next question. Okay, all right. Okay. All right, so this one, let's get to the answer. A, 55% of you believe you must own an asset to have it on the balance sheet. 45% think that you don't have to own it. All right, so somebody, could you call someone for me? I want to see if you have a name out there, and I want to get some folks to participate. It's like a game show. Who's our next contestant? Anyone? Who's that? Was that you? Oh, all right. Who do we have? Okay. There he is. Okay, so we're going to get you now. Oh, hold on. Okay. We'll do this for a couple of questions. Let's just see. All right, come on. Question is, all right, why did you pick A or B? Okay, why? Why would you have to own the asset? Do you have to own the asset?
Yeah, you
You have to own the asset. What does ownership mean? Title. Anyone? Okay, now we'll take another person, but this time at random. How else could you have an asset on your balance sheet? If you lease it. You do not have to own it. All right. So, the answer, guys, the answer is false. But you got to make sure you know why. Assets are defined as what? Economic resources owned or controlled. So let me say it again. Assets, hold down. Don't forget, you get tested on this stuff. Stuff starts to count. Okay. All right. Assets are economic resources that are owned or controlled by the firm. How do you control an asset you don't own? You lease it. All right. So that one is definitely false. All right. Next one. Let's go to the next one. This time, let's see if we can do a little bit better. All right. And by the way, the purpose here for me is to go over material that you're not getting. And obviously, if most people thought you had to own the asset, I might have missed something too. All right, so next one. Liabilities can be paid by delivering a product or service. All right, so let's say. You got 2 for participating, 4 for the correct answer. Okay. Okay. All right, so people said that 88% of you believe that liabilities can be paid by delivering a product or service. What do we have? Okay. You had A. Okay, so how does that work? And I'll repeat it. I'll repeat it if we can't get the mic. Don't we get in the mic? Yeah, sure. Okay, there you go. Okay. All right, so I wanted to know if you could pay off a liability by delivering a product or service. So how does that happen? Just explain the scenario. And
We define liability as something
well, it's something you owe.
that's debt.
Yeah, it's a debt, something you owe. So how are you paying it off with a product or service? What must have happened? Why would you owe someone service? Should we? All right, let me get someone different with the apple. Okay. Right, okay. All right, so the answer is correct. Someone gives you cash in advance. It's an advance collection, sometimes called an unearned revenue, which doesn't make any sense to most people, but we have our own language. So it's unearned revenue advance collections. You paid for season tickets to, I hope, the Jets, right, instead of the Giants after this weekend. So you paid for season. You paid for season tickets. You paid for season tickets. The Jets or the Giants owe you, 8 home games, right? So if they deliver the home games, every time they play a game, they pay off that liability. You go online and you hopefully get a subscription to the Wall Street Journal at some point. That online subscription is for a year, 2 years. They owe you the right to access that periodical. Okay? So if you pay for something, if you collect something in advance, it's a liability to you. Okay. Got one more for you, and then we're going to move ahead. Okay. This is a good one. This one wraps up. Oh, sorry, I have a question. Yes. Okay. If the click is not working, just kind of let me see the channel. Channel 41. You're on channel 40. Okay, you're now on channel 41. Okay, you guys got to be on channel 41. All right. So let's take a look at this. We just covered this. We're going to wrap up and move ahead. Okay, so let's go. Expenses and dividends reduce both equity and income. Okay, does it? Okay, let's see. Okay, thank God no one hit C. Someone hopefully couldn't see and hit D by accident. All right, so the answer. Well, first of all, let me see if you could see the answer on the document. Dividends reduce equity. Expenses reduce equity, but what reduces income? Only expenses. All right, so only expenses reduce both. So the answer to that question is false. So it's true, yeah, it's true they both reduce equity, but only expenses reduce income. Okay. All right, so that wraps up this part of the chapter, and we're going to move on to transactions analysis. Now we're going to start, yes, question. Equity, yeah, reduction of equity. So expenses, the question was, what's the definition of the reduction? The reduction here is equity. Okay, any other questions before we move ahead? All right, we're going to now move to getting closer to the dreaded bookkeeping. We're going to start looking at recording transactions, and the first place we're going to record transactions is going to be in the accounting equation. This is very impractical. We won't do this for very long, but it is going to set the stage for the foundation or the fundamentals of recording events. So when you look at transactions, transaction, of course, involves an exchange of resources as well as an ability to measure it. So, very simple example, if you buy a copy machine, that's a transaction. You're giving somebody cash for a piece of equipment. It's an exchange of resources. What is not a transaction is meeting a customer. There's no exchange of resources. I'll give you another example. You go in for an interview, you get hired, you fill out all the paperwork. That's not a transaction. That doesn't get recorded. The only thing that would get recorded is when we start paying you, when you start working. So the hiring process, meeting with clients, these are not economic events. So the two issues are whether or not you should recognize it, and when you do, how you measure it. Recognition means you have to have an exchange of resources. Measurement is, of course, in terms of a monetary unit. Now, going back to those little concepts we had last week, monetary unit assumption, these are going to be events that are measured in these economic, in these units or monetary units. Now, one of the things we'll find out with the transactions analysis, which I think we implied last week, is that we have double entry bookkeeping. Anytime you make an effect or you have a transaction that affects the equation, it's got to affect it so that the equality of the equation is preserved. So, for example, if you have an individual asset that increases, and I'll show you this on an equation in a second, if the equation increases an asset, then you have to either have another asset going down, or a liability going up, or stockholders' equity going up. So, in terms of the equation, that's what it looks like. Excuse me. So that transaction A says, well, I might have used, and I'll show you that in a minute, I might have used cash to buy office supplies, right? You're swapping assets. Equation balances. In entry B, I might have purchased office supplies on a liability. I might have borrowed or had an accounts payable. Or C, assets go up, cash comes in because you invested in the company. So you just sold some stock and you invested in the company. How about, give me another example. Can anyone think of another example for C? What increases equity and inflows resources? Revenue, right. That could be a sale. So if you sell something, you're going to have an inflow of assets. Remember, the definition is strict. Revenue is an inflow of assets or a reduction of a liability. And the reduction of the liability was the discussion we just had before about those unearned revenues. All right, now, what we're going to do is we're going to go through an illustration that comes from your textbook that's going to walk you through 9 transactions. Those 9 transactions are going to be recorded on the accounting equation, and we're going to use the accounting equation not only to record the transactions, but to build financial statements. So let's go through the transactions, and then we'll try to build those statements as well. Okay, so here's the first one. We have this company, which is in your textbook. I guess they use the same company all the way through. Smart Touch Learning starts a new business. The company issues an initial public offering, an initial offering of stock. By the way, what you have to remember, these are initial offerings of stock. When the stock trades every day, it doesn't affect your company, correct? Think about it. If someone invested in Facebook the first day, it was offered, it was a public offering for the first time, those shares were sold, Facebook takes the cash. Today, when Facebook trades, you and I sell stock amongst each other or between ourselves, that doesn't affect Facebook at all. Okay, so it's really when the first investment takes place. And here it is. what you would do is increase the asset cash for the cash inflow and increase equity through contributed capital. So here you have an investment. It's not income, it's not revenue, but it is an inflow of assets from the investment by the owner. So that's how we could start the business. Now we could start operating. Next, we use some of that cash to buy land. Now you notice what happens in here, if I can sort of point this out. You're taking cash, you reduce the asset cash, and you increase land. Notice that the equation still balances, so you have a reduction in one asset cash and you increase land. Now what happens here is that you've changed the composition of the assets, but not the total. You still have $30,000 in assets, the equation still balances. So you've changed the composition of the assets, but not the total. You've taken a non-productive asset, cash, and you've converted it into an income-producing asset, which would be land. So again, you convert one asset to another, does not change the rest of the equation, and the equation is still in balance. And that's one of the things you have to do. On the assignments, when you start digging into the Chapter 1 assignments, which you could do today, they're due Friday, you're going to see, make sure you got everything balanced here, $30,000 in total equity. And by the way, you're the only one that's claiming those assets right now because you're the only person contributing. You have no debt. You financed everything through contributions, and therefore you own everything. You got the cash account and you got the land. Now, we can also start operating by buying some supplies, and we could do this by buying the supplies on account. And what does it mean to buy them on account? Well, you're going to have an accounts payable. You have a liability. As we said on Friday, the liability accounts payable is an open trade account. You don't sign anything. You don't sign a note. There's no formal document. You just go online, you place your order, or you call somebody up, place your order, you have now an accounts payable. You owe someone for that product. So we bought some office supplies. We increase the asset office supplies on one side of the equation, and we increase accounts payable on the other. Now, the question, of course, is does the equation still balance? And it does. You got $35,000 in equity and liabilities, and you have $35,000 in assets. Right now, your claim is $30 on those assets. The outsider's claim is $5. So the resources are $35,000, and the claims against those resources are $35,000 as well. All right, so those, I'm going to stop here before we do revenues. So that's the way you have to work with the equation. It's a pretty simple equation. I mean, something everyone should, I mean, obviously you can, A is equal to, L plus E. That's pretty simple. And I think here we've hit most of the, I guess, the easier to explain transactions. Now, any questions before I go on to revenues and expenses? That's where it might get a little bit more complex. Okay. All right, so let's try a revenue. The company provides services to customers for $5,500 in cash. So now what happens is that your equity is going to go up by 55, and that's your service revenue. Notice it's not contributed capital because this is not an owner event. This is an external event that is going through service revenue, and this is a cash revenue. By definition, a revenue is an inflow of assets. The asset inflow right now is what? Cash. It doesn't have to be cash. I could pay you in something else. I could pay you in, inventory. I could pay you in shares of stock. But I'm paying you in cash. Cash goes up, and so does service revenue. Right now, your income is $5,500. You have no expenses. So, and your wealth went up as well. Now, in this case, you have 36. This transaction 4. You have $36,000 in total assets and $36,000 in total stockholders' equity. The equation is in balance, and that's the key. Now, the next one, this is the one I really want you to focus on. I'm providing service to a customer, but they didn't pay me yet. Do I still have a revenue? Yes. Just remember, we're not on a cash basis. So you and I, maybe, we like to think in cash. If you don't give me cash, you didn't pay me. That's not true. Here, you have a receivable, which is a claim to cash. Accounts receivable is an open account. Again, usually they have to pay you within, 30 days? Just like accounts just like accounts payable. So notice your revenue goes up, but not cash. So revenues are defined as inflows of assets from providing goods and services. What's the asset inflow in this case? The receivable, right? So there's an asset coming in, but it's not necessarily cash. And right now, your income is $8,500. Right now, your income is $85,000. Any questions on those two? I want to make sure, we have everybody in the game. We differentiate the revenues from cash, revenues from receivables. Right now, your total revenue is $8,500. It doesn't matter if you collected it or not. Just like if you work this week, you had a part-time job, you worked, you get paid next week, they still owe you that money, it's still income to you. You may not think of it as income. I mean, some of us spend our income before we get it, so maybe some of us do think of it as income. But again, if you don't collect it yet, it's still a revenue by definition because you have a claim or an asset. Yeah, we have a question right here. Yeah.
When we do the homework or like emphasize whatever, are we going to have to know the titles like cash, accounts receivable, or are you going to...
It should, no, in the assignments, there should be drop-down menus that you have to know what you're increasing or decreasing, but, yeah, they should give you the titles, right. Question, yeah. In this case, okay, here's the question. I said total revenue is $8,500. In this case, I could say total retained earnings are also $8,500. It may not always be true. It may not, because there could be dividends coming out of there. So revenues, and it could be expenses as well. The question I thought you were going to ask, which I'm going to bring in, is, okay, I've got, $8,500 in total revenue, but my cash flow from sales is only $55,000. The cash income is only $55,000, but my total income is $85,000. Okay. All right, so you can't necessarily say that, yeah, in this case, just because we have nothing else going on, revenues and retained earning change happens to be the same. Okay. Any other questions on the two sources of revenue in this case? All right, next, expenses. Transaction 6. They paid $3,200 in cash for rent, $2,000, and salaries rather for $12,000. Notice that again, this is coming in your retained earnings. So this is your income, right? You got service revenue $8,500. You got rent expense for $2,000, and you have salaries expense for $1.2. When you pay those expenses, it's a cash expense here. Doesn't necessarily have to be a cash expense. So you reduce cash, and then you go ahead and you reduce retained earnings for the use of resources in the process of creating revenue. What's your net income right now? What's net income by definition? It's revenues minus expenses. So all you have, by the way, as I said in the first class, if you weren't here, toughest thing accountants do is divide. So as long as you can add and subtract, sometimes we divide, you should be okay. So $8,500 minus the expenses, you should have income of $53,000. Your net income should be $5,300 at this point. $5,300. And of course, your equation, does it balance? When you add up all of those assets and you add up all the liabilities and equity, it should be $35,800. Okay. All right, so any questions on the expenses? Yes, I have a question. I'll repeat it. Yeah.
So net income is revenues minus expenses?
Yes.
Okay.
Net income is revenues and gains, if you have them, and subtracting from that expenses and losses. Okay, yes?
Is rent not considered something that you have control over? Because I'm confused as to why it's not an asset.
Only if you paid in advance. So if you paid 3 months in advance, 4 months in advance, it's an asset. It's prepaid. Okay? It's a real good question because technically, I'm going to say you're right. If I paid this rent for the first of the month, somebody owes me occupancy for a month, so I really have an asset. But actually in accounting, from a practical standpoint, due to the fact that I know that this is going to be gone quickly, I expense it immediately. Okay, but you're making a real good point that if I paid for rent in advance, I've got an asset. Somebody owes me occupancy for a month. I have a question in the back. You might need a mic for that one. That's correct. Revenues minus expenses, but as I said, what you might want to add is revenues and gains. Subtract from that losses and expenses. And we're not going to see any losses and expenses in this particular case. Okay. Yes, sorry. If you've prepaid car insurance, it is an asset. If you pay for insurance and use it up, it's an expense. So what you're both asking some good questions, and we will get to this. I'm not trying to put off the point because you're making some real good points, and I encourage that. What we're saying here is that in the event that you pay for something before you receive it, you have an asset. So if you paid for insurance now and you use it up now, it's an expense. So we're assuming that all of these services were provided here. Okay? All right, let's go to the next. In the next case, this one, transaction 7, this one could be a little bit sticky. The reason why I say that is we're paying off the part of the office supplies. Now, this is not an expense. You're just paying off a liability for an asset that you have on your books. Now, getting back to your question and the question I had before, the comment, office supplies are something that I still have to use, and they're still assets to me. I didn't use them up. So what you have to start to think about is if I pay for something and it's used up, and when I use it up, it's an expense. If I pay for something and I still have the use of it, it's an asset. So if, in this case, I'm paying a liability, so I reduce the asset cash and I pay down the liability. And this liability related to those office supplies. Okay? It is not an expense. This is where I don't want to see it happen, believe me, but a lot of you are going to get tripped up. You're going to read this transaction, and that's where it takes a lot of practice. That's why I want everybody to get online, get moving with everything. I know, a lot of you just joined the class. When you start practicing, it's not that difficult. If you have the book, it helps. You got a lot more examples. So if you see these transactions over and over again, you'll know how to interpret them. So this says you're paying $300 to the store that they purchased the supplies from. You're paying off that liability. And it says on account, which is a hint. It means accounts payable. All right, and the balance sheet still balances. The assets are $35.5, and the liabilities and equity are $35.5. Okay, notice again, we're only looking at two parts of equity, contributed capital and retained earnings. Let's go to the next. Transaction 8. Now they collect services from the client that they had an accounts receivable. So you're collecting an accounts receivable. Here's an important point. In transaction 8, make sure you realize that this is not revenue. You're collecting something on account. So you increase the asset cash, you reduce accounts receivable. Again, you change the composition of the assets, but not the total. The balance sheet still balances at $35.5. It's not revenue. The revenue was already recognized back here. You have to remember you recognized $3,000, I believe, in revenue on account, and now you're collecting $2,000 of it. The revenue doesn't change because it was already recognized. So revenue was already recognized. You don't recognize it again. And you've got to practice. You've got to make sure that you see this clearly as you progress. Now, there's one more transaction that, for some reason, they didn't give us a slide, so I'll have to work with the summary. But before I do that, any question on 8, anything on 8? 8 is very important for you to really get it clear that you're collecting on a previously recognized revenue. So that if you, for example, if you had financial statements as of today, and you worked last week, but you didn't get paid yet, that's your income. When you get paid, let's say this Friday, it's not income, you're just collecting on income previously earned or previously recognized. Think of it on a personal level. Okay. Now, got one more for you, and that's a dividend, so I don't know if we're going to be able to see this one That one's on the way on the bottom here. And if you have the slides, you'll see they paid $5,000 in dividends. Notice that the retained earnings are being reduced by the dividend. And I'm sorry they didn't give us a slide. I didn't make one up. Couldn't make one up, actually. So the dividends are reducing retained earnings. They have nothing to do with income. Your net income is still $5,300. This is a distribution of that net income. And then, of course, we paid out in cash. Now, when you look at this, you notice that cash, we started with 0, goes up by $9,000, and assets, accounts receivable is up by 1, office supplies by 5, and you have a land of 20, and of course payables of 2, your common stock is 30, dividends are 5, and of course your revenues minus expenses would be your net income. At the end of the month, the transactions result in total assets of $30,005 and total stockholders' equity of $30,005. Now, at this point, the end of the month, we could prepare financial statements. Yes?
If you were taking out a loan to pay off the dividend, would that be an accounts payable?
Yeah, I mean, if you had to borrow money, I mean, you probably wouldn't do that, but this is a good question. If you borrowed money and used it for operations, it would be either an account or a notes payable. Remember we said last week a note payable is a formal document. Yep. So I guess what you might have here, if you have a dividend declared but didn't pay it, what would happen? There would be no cash effect, but you'd have an increase in some kind of a liability, like a dividend payable or a dividend liability. That could happen. Okay, it's a good question. Okay, let's get some questions for you. Let's make sure you understand what we just covered. And to do that, we'll go to question for this learning objective. And we want to know, if an asset decreases, what will result? Would it be a decrease in another asset, a decrease in a liability, increase in stockholders' equity, or a decrease in liability? So let's see, I'll give you a minute on that. And again, as we go through these, you know, if they're not familiar, you should start looking at them before you get here, I hope. All right, just about winding down. And let's see what we got. All right. Okay, so most of the class thinks it's B. And let's see. It is. Okay, so what would happen is that if an asset decreases, the only choice that was correct here is that you have to decrease a liability. And I'm using these equations to give you like sort of a habit. You know, when you look at these things, draw them out. This is like a real simple equation. I mean, you know, so you really don't have to struggle with it too much, I don't think. So if we go back, okay, so the answer to this first question is B. Okay? The answer is B. Okay. All right, now, let's do another one. I want to skip this one. By the way, just to tell you, if an entity purchases office supplies on account, we pretty much did this one already. The answer is C. Okay. The answer is C on this one. We just finished this one in the illustration. All right, here's the one I want to look at. The change in the retained earnings account is equal to net income or net loss for the period. A very timely question because someone just asked me this a few minutes ago. So, Okay. All right, getting ready. Getting close. All right. So hold down. We got an interesting split here. You're saying that. Let's look at the question again. All right. So let's look at the question again. The change in retained earnings is equal to net income or net loss. I didn't say a change, I said the change. And the answer is false. And here's why. There you go. The change in retained earnings is net income or net loss for the period minus dividends. Forgot the dividends. So the answer is B. Now, let me make sure, because most of the class put down A, which is wrong. And this is not what I want to see. I want to make sure that you understand the issues. Retained earnings changes by net income and net loss for the period minus dividends. Okay, and the question we had before, the question was the revenue or whatever we had there, is that the definition of retained earnings? And I said for now. But you can see it's a bit different. So when we go back, okay, make sure you copy that, and I'll. Okay. All right, any questions on that one? Got a few more to go. By the way, the next module will start a little bit. Friday, definitely chapter 2. The next module is going to go pretty quick. Yep.
This only affects one change, right? That's what not the change.
Yeah, it's not a change. If the question was, here's the question: is it a change? A change in retained earnings could be revenue, it could be gain, it could be expense, could be loss, could be dividends. But the change itself for the year is net income or net loss minus dividends. The change for the month, net income or net loss minus dividends. The total change in retained earnings. So
So it's either or? It's either or, either net income or net loss?
yeah, that's right. Yeah, you could have an income or loss.
Oh, it's not both. That's
No, income or loss, right. You want to know if it's income or loss, that's right. Okay. All right, now, got another good one for you. Let's go to this one. All right, what I want to know is, in this case, what is the company's net income or loss? All right, they could have income or loss for the period. All right, so this one you got to work on this one. Read it carefully. This has to do with, because you're supposed to be doing these in advance. If you read expectations in the course outline, by the way, course outline has a lot of good stuff in there, like how to register clickers, how to get clickers, how to prepare for the lectures. All right, so I'm only going to give you a minute because I'm expecting you to be ready for this. All right, so it says, I want to know what the income is, and this is a review of what we just did. If you collect, is it always revenue? If you spend money, is it always an expense? Oh, man, only 12 people are in, huh? All right, it's going to be a light turnout. Okay. Well, they're all coming in now. All right. Okay. We shouldn't say you surprised me. I'm happy that it is D. Because let me show you why. Hold it down. Here's the important point. The important point for those of you that didn't get it right. Let's read this carefully. They got $2,000 in revenues on account. They collected $4,000 from something they sold last month. I just told you a few minutes ago that if you worked last week, that's your revenue on account. If you get paid this week, it's not revenue this week, it's earned last week. So if you earn revenue today on account, it's income. If you collect it from something you did in the past, it's not. If you incurred expenses of 6, it's repair expense. If you paid cash for a supplier for something you bought last month, it's not an expense. So the answer is very simple. It's 2,000 minus 600 or 14. Okay. All right. So now, so make sure that you understand these questions carefully. Hold on. All right, we got a question here. Yes. Right. Well, if you earned it, yeah. Okay, here's the question. Hold it down. If you earned revenue last month, what you collected this month is not income, it's a collection of last month's revenue. So it's only recognized when you earn it. So again, you work last week, you get paid every 2 weeks. Okay? Your income from last week is revenue from last week. If you get paid this week for it, it's not income this week.
Oh, that's so good.
Yeah. Okay, questions? Hold it down. Yeah. Yeah. That would be a swap of receivables in cash if you collected last year's. Okay. Anything else? Hold it down, guys. You still got, I don't know. I know I live in New York, but I'm not in a different time zone. All right, we still got some time. Yeah.
So that's $200 in supplies expenses.
Hold it down. We're still here. I'm still here. Yes.
That's $200 in supplies expenses. It says that was paid for last month. So
We go back to the $200 you paid off a liability you incurred last month.
So that one was already paid off for the month before August.
Yeah, right. Okay. Now, what we're going to be doing is, thank you. What we're going to be doing now is using the accounting equation. And let me see if I can get this on the screen. So if you remember this set of transactions, let me bring this in a little bit. Okay. If you remember this set of transactions, we had the 9 transactions from Smart Touch. We're going to be using this to prepare financial statements. The financial statements we're going to prepare will come directly from the equation. The equation is going to operate as your set of books, so to speak. So the financial statements we're going to prepare are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. These statements are used to communicate information to external parties. If you remember way back last Tuesday, that was our first class. We talked about the use of financial information to communicate that information to outsiders, stockholders, and creditors. Now, the order, I'm going to say this carefully, we'll see it. This is the way the statements in this course would have to be prepared. You've got to prepare the income statement first. You have to prepare the retained earnings statement second. Then you have to go to the balance sheet and then the statement of cash flows. When we look at an income statement, I'll get through this first and we'll stop. The income statement reports the operating results of the company. As I said, net income or net loss, that's got to be prepared first. In this case, it is pretty simple. We already know the net income of the company. What was the net income of Smart Touch Learning? It was revenues of 85. It was expenses of 32. So we know that the income statement will just list the revenues and expenses, the net income or net loss over the period of time. And again, it's the change in your wealth for 1 month, 1 quarter. We're talking about that. You measure income for each period, if it's 1 month or 1 quarter. Now, the model of the income statement, again, revenues or gains, asset inflows or reductions of liabilities, minus expenses or losses. And here it is. This is the income statement for Smart Touch Learning. A couple of points to recognize. Hang in. You got the title of the company, So remember, if this is an exam or homework or a quiz, and you have to, that always applies to you have to basically have the title of the company, the income statement, and it's for the month ended. It's a flow. The income statement is over a period of time. So if you remember, if we go back to the accounting equation, we know that we'll use the accounting equation we're going to use this accounting equation to recognize the revenues of $8,500, the expenses, we have rent expense, and we have the salaries expense of 1.2. So the net income for the year is, or the period for the month is $5,300. Now, one last point, I'll tell you what's coming up. You got rent expense is $2,000, salary expense is $1,000. The order in which you place those expenses is going to depend on the company, but typically you do it in the order of magnitude. The larger expenses come first, then the smaller expenses. But if you had a company like Johnson & Johnson, what expense would probably come first? Research and development, research, and probably advertising. So for consumer product companies like Procter & Gamble, the most important expenses would be advertising and research, and they would come first regardless of the size. For you, on an exam, I would expect you to list the expenses in the order of magnitude. All right, now on Friday, we're picking this up. We're going to Chapter 2. All right, want everybody to be prepared. By the way, if you got questions, hold it down. Got questions, you can email me. I've been pretty responsive, okay? And I'll talk to you after class. Yeah.